Hello everyone, this is a short video to highlight trading off volume nodes in the profile. Now this is from the 7th of June 2016, and at this time the market seems to be really slowing down. So here we can see the Dow is moving up, but the NASDAQ is moving down, and we have an open at 2109.50. We can see that the bids and offers are really thick, averaging 900 or more than 1,000 a level, which is quite unusual for the ES nowadays. So on a day like this, we have to consider that the market will be non-directional and that fading a market is the strategy to apply. So looking for longs at the bottom of the range and shorts at the top of the range. Now you obviously need to do that with some sort of confirmation, and we'll look at that in a second. Now I wouldn't consider this to be reversal trading, trying to catch the top or the bottom of the market on a more normal day in the ES, because as the market slows down, attempts to follow the trend are actually going to be the trades that stop you out. And as we move into the summertime, the markets do traditionally slow down and we get a smaller daily range. And as I say, this catches a lot of people out. So let's look at one of the ways these ranges often turn. As we move off the top of the range, we can see a lot of size hitting into the bids on the way down. And that's typical of a slow, thick market. Now watch as we get down to 1025. This isn't the bottom of the range, but it is a slow day and it is fairly early on, so we do have to be a little bit flexible and not necessarily wait for it to get to the bottom. Now as we get to 1025, we can see an exceptional amount of volume trade there. In the end, we trade 2,244 contracts at the bid and 2,678 at the offer. So we know now that there are a lot of positions there, and we can see that both on the trades column and with the large circle on the depth and sales. Now we could take a trade on seeing that volume, but in this case we waited for it to test the area again and then got in. No particular reason for that other than just a little bit of caution. Now if you think about it, with that many positions there, as we move away we should get a little pop as those people stop out, or as one side stops out. And that makes these trades very good in terms of risk. Your risk is really just a few ticks outside of the zone, because once it starts to move away, one side will bail out. And obviously your reward is greater because when one side does bail out, that will actually give you the pop. Now, I'm not saying you should take a trade at every area where excessive volume builds. But in this case, we had the context of a range-bound day, and if the market had moved down a couple of ticks, we could have got out. The target was the top of the volume area at 1225, so 7 ticks potential reward against 2 or 3 ticks risk. So just bear this in mind as the market slows down, and bear in mind the key here is building that cluster of short-term positions which builds up and which gives you a pop when one side stops out. Thank you.